Welcome to today's webinar, compiled and produced by the team at biznews.com. All of our webinars are interactive. We encourage you to pose questions to our guests. The more challenging, the better. And the earlier you get the questions in, the better the chance of having them answered. The recording of this webinar will be available later today on the biznews.com channel on YouTube. Yeah, well, there we are. We are in our first webinar of the year. It's on the 26th of January, and it's been, well, again, quite an extraordinary performance by the Biznews portfolio. We'll be talking about that in a lot of detail coming up. We've also decided to add our first Australian stock. Stu, I think that's going to make our colleague Clive Eckstein feel a little bit bitter, because he doesn't like the Aussies as much as he should.
I'm sitting across from him, Alec. I can see the smile on his face.
Oh, smile, not daggers. Well, that's good. Then he must have had a good golf game yesterday. Stu, do you want to just take us through the details of the tech and how people will make sure that everybody who is in attendance can hear us?
Excellent, thanks, Alec. Yeah, just quickly, if you can see Alec and myself and see this spreadsheet underneath and hear my voice, there's a little high five button on the control panel on the right hand side. If I can get a few high fives just to make sure everything's coming through loud and clear. Ah, lovely stuff, thanks. All lots of high fives, Alec. And as in the intro it does say, we do like to keep it conversational. In the same control panel, there is a questions drop down. If you can put your questions in there, I'll pass them on to Alec as he runs through. But I'm sure we've got some exciting insight on this new company, Alec, which I'm sure people are looking forward to.
Yeah, there's lots on Xero to talk about and explain exactly why we brought it into the portfolio. In fact, we've got a lot of ground to cover. So I would suggest that you do get those questions in early. As Stuart says, if there's anything that is bothering you, just type it in on the question mark and he'll pick it up and stop me in my flow. Okie doke. I think you've had enough of these two not such good looking guys. Well, let's switch off those cameras, but you know we are here, we're not cardboard cutouts. And as you can see, good start to 2021, compound annual growth rate now in US dollars for the portfolio, and we've been going for 6 years and 1 month, is sitting at 24% per annum, and in rands we've edged back above 30%. That was helped by a good month for the portfolio again, and by a decline in the rand from where we were in December. But those are kind of bits and pieces. Let's go through the overall performance in the past month. Remember, this portfolio was started in December 2014. The whole idea at that time was to give us some kind of a hedge against Zoomonomics, which was starting to grab or South Africa by the throat. Well, we know we're still paying for it today in a very poor economy, which has been made even worse by what's happened with COVID. But the idea was to try and get money offshore, invested in a way that it would perform better than if it had just been put into US dollars. And the way to do that would be by investing in shares on the American stock market. Equities in the long term always outperform other investment classes. They can go up and down, as we well know, in the short term, but in the long term, equities are the best place to put your money. And the idea there was through Standard Bank Web Trader to make investments where you start earning as you learn. So every month when you come back to this webinar for Biznews Premium members, it gives you insights into what's happened with those companies that we've invested in, and hopefully you've invested alongside us as well. Okay, so that's kind of the breakdown of the past month. As you can see, we started off, by the way, in 2014 with 2.2 million Rand, and the power of compounding when you compound at 30% per annum, as has happened here, it takes you up to 10.5 million rand in December, and now a new record of 11.3 million rand. We had a good increase in rand terms in the past months, helped along by a depreciation slightly in the rand, and then a good performance of the portfolio. And there were three stocks that shone. Apple was up 17%. Remember, this is in the month. Naspers has been a phenomenal performer in the month, and so has 2U, which was one of our laggards. It's now in the right direction. In fact, it's making a small profit after it had been, together with Wilson Bailey, one of the two losers on the portfolio. Wilson Bailey fallen 17% in the month. I did write about that in the Rational Perspective newsletter a week or so ago. The idea being that if South Africa is going to grow, it's going to need infrastructure. If it's going to do infrastructure, it's going to need Wilson Bailey. So although the share price has come back on a pretty soggy investment climate in South Africa, and the disappearance of a takeover bid by a Chinese buyer for the Australian operation, Wilson Bailey's Aussie company is actually more than half of the revenues of the whole group. But the Aussie government said, we don't want Chinese to be owning this company. It's too strategic. And that has seen the share price of Wilson Bailey fall as a consequence. We also saw in the past month a decline in the Discovery share price as the second wave of COVID-19 started taking off. The view was that Discovery had over-provided for COVID-19. The view now is maybe not so much. And already, as you've been reading on Biznews, there's concerns about a third wave. So this COVID pandemic is really very, very challenging for everybody. But we have brought in a new stock. You might remember last month we cashed in our chips on Slack. We bought Slack a while ago. It performed adequately, and then there was a takeover bid from Salesforce.com. We decided to sell our Slack holding, which was an obvious thing, and just put the money aside, $36,000 US dollars at that point in time. And we have now decided to acquire or to allocate that money into our first Australian holding. And that's one of the benefits of Standard Bank Web Trader, is that you can literally buy shares on pretty much any stock market in the world. You'll be able to find the Xero share by just putting it into your web trader. And I've been waiting for it to come back. It hasn't really been doing so. But just from a philosophical point of view, let me explain a little bit here. The reason why this portfolio has been focused in exponential shares is because I have the benefit of working in a business that grows exponentially, and that is the internet publishing business, or if you like, the whole digital business itself. We've seen from our own company after once the lockdowns came in, how Biznews has really aggressively grown way beyond what we thought it would do in the very short term. Well, for instance, there are more people on this webinar, which by the way is only for premium members, than our record pre-pandemic. So it gives you an idea. And of course, our free-to-air webinars have got hundreds more than what we have here. But it just gives you an understanding of the way that South Africans have almost been pushed into the digital world by the lockdown. We've worked from home. We've had to use technology more. We now see the benefit of something like a webinar rather than the face-to-face meetings that always used to be the preference in the past. And the whole digitization has accelerated the companies that we deal with. For instance, Slack, the company that we use here at Biznews, which is well used for a remote company, as for communications. It's a vast improvement on emails, for instance. That has accelerated its growth, and we've seen the share price, of course, attracting the attentions of a takeover bid. It's been similar with Cloudflare, which is a fully digitized company. They are a protection for businesses on the internet as far as their security is concerned. What Cloudflare did, one of their innovations, which shot up the share price, was that they found a way of protecting remote workers. So in the past, you went into an office, you had a big firewall around the office, almost like a moat around a castle. now with the innovation that Cloudflare has done, and by the way, they are the global leader. They had been the global leader already in internet security, but they innovated a solution so that when you go home, you're also protected, even though you aren't sitting within the castle moat. That has given their share price a big boost, and so on. So what we've done here in this business is not in the portfolio, rather, is use the benefits that we have as a business at Biznews, understanding the exponentiality of the digital era or the digital companies, hence the investments in Amazon and Apple, etc. But we've also targeted companies that you might never have heard of because we've been using their products in our business, and we have seen the benefits of their products being world leaders in their areas in the way that they allow you to scale your business more if you're a digital business. I hope that all makes sense. Xero is one of these products. We've been using Xero as our accounting system pretty much since we started Biznews going on for 8 years ago. And it compares with, I was actually talking to one of the bookkeepers who used to work for us at MoneyWeb, where we had 4 people in the bookkeeping team, or the chartered accountant and an accountant, and then 2 bookkeepers. And you think of the costs that entails versus Xero, where you pay roughly a couple of $100 a month as a subscription fee. So it's another one of those digital companies that attracted my attention because I've used the product a lot, and my goodness, it's a phenomenal product. If you haven't used it before, just try. And remember, we have a business in the UK and a business here in South Africa, and it's easy enough to integrate them both on the Xero platform. So very, very high quality offering that they have. But what I like about this business is that it has done what many of the successful investments for us have done as well, when they break through into profitability. First of all, when you go into a digital business that is expanding rapidly, an exponential business, your biggest question mark that you have is it properly capitalized, and how far are they away from generating free cash flow? I'm going to talk a little later about Netflix, but Netflix's surge after the quarterly results that have just come out is because after years and years and years of having to borrow money to do its products, it's now broken into producing free cash flows. Netflix will not have to borrow any more in the future. And it's if you can imagine that hockey stick effect, it's very hard for us as human beings to get our heads around exponentiality. It's even harder for us to get our heads around what happens to a company that is breaking into free cash flows, and then it's also expanding very rapidly. And this is what excites me about Xero. It has now confirmed the break into free cash flows in the financial year to March 2020. The most recent financial results, which were to September 2020, so it's the first half of the March 21 year, show a further acceleration in those free cash flows. This for the financial year to March 2020, the numbers were pretty good, as you can see. Nice improvement there. They had free cash flows of 27 million Aussie dollars. In the interims, the latest, just for 6 months, their free cash flows are $54 million, just for 6 months. So that graph that you see in front of you, when they come to finish the numbers for 2021, you're going to be going from, well, it's going to be a much, much bigger slug that we'll go to. Probably if they do 50 in the first half year, well, they'll probably double that. So you're looking at 100. And remember, this was the year of COVID-19. And this is a company that is focused on small businesses, which have been amongst the hardest hit. So if it's starting to really, really cook with gas during COVID-19, imagine what's going to happen when things go back to normality. The real story for Xero, though, is that it's a New Zealand business which moved into Australia, and from there it's got a very strong base now, more than 1 million subscribers in Aussie and New Zealand, and from there it's moving into the rest of the world where it's growing exponentially. if you have a look here at the net subscriber additions, remember this is to March 2020, so it's a little out of date, and I can give you the updated figure for the interim. But it went from 432,000 growth. This is the new subscribers. They put on about 450,000 in the 2020 financial year, and that growth has continued. The subscriber growth in the 6 months, despite COVID-19 and despite it being focused on small businesses, was nearly 400,000 just for the first half year. So it's giving you an understanding that they've grown almost as much in COVID for the first half year of the current financial year as they did for the full previous financial year. Interestingly enough, one of the fastest growing areas is South Africa. They actually mentioned that. And the rest of the world, as they put it, outside of the UK, North America, New Zealand, and Australia, is growing fastest. That's up by 37%, but it's only still 5% of their total subscriber base. And once people start getting that opportunity to see this incredible product, which comes out of New Zealand, and you say, oh goodness, what do New Zealanders know about software? I remember years ago in the horse racing industry, there was software that came out of New Zealand that was world beating. It was Tessio Power, it was called. It helped. It was just so much better than anything else that was available elsewhere in the world. So I don't know what it is in New Zealand that they're doing on the software side. Indeed, they might be promoting it through government, but this is a business that was started by a guy called Ron Drury in 2006, 3,000 employees, and it is one that is now starting to take on the whole world. So it's a brilliant product based in Australia and New Zealand. We in South Africa are embracing it. And remember, this is a company which was very much a Sage, which is the main competitor to Xero, a Sage stronghold. Ivan Epstein, who started Softline, he was on the main board of Sage. So we were well endowed in this country with Sage products, and Xero are growing faster than you can imagine here. So if you can do that in South Africa, imagine what can happen elsewhere in the world. There's the potential that they're looking at. As you can see, they're still growing in Australia and New Zealand. New Zealand less so, because they've pretty much saturated that market. Australia still going quite nicely, but look at the exponential growth in the other areas. And that's what I'm betting on here, that I believe that it's a great product and the exponential growth will continue for some years into the future. What's lovely about exponentiality is that you create huge amounts of value. I'll just quickly stay with this for a moment. What you do in our businesses as premium subscribers, the number of premium subscribers we have at Biznews is the value of those premium subscribers is calculated on the basis of how long they're going to stay with you. So if you have a churn rate, in other words, if you guys who on the webinar come in, you come for 1 month, then next month you cancel, well, then you've got a churn rate which is very high. If you have a very low churn rate, which we have, our churn rate is about 1%. And that means every month we lose like 1 in every 100 premium subscribers. We work very, very hard at keeping that. Well, these guys at Xero have a churn rate of 1.13%, which is very, very, very low. And you wouldn't be surprised at that, because once you adopt a new accounting system, you kind of stay with it, because to move from one accounting system to another is like moving a bank. As a consequence of this, what you do is you take the value of those subscribers, the number of subscribers, remember here they're sitting at about 2.5 million, and then you multiply that by how much each subscriber will be worth to you over their lifetime. That's the way that analysts look at it, just as what we used to call the old net asset value in a company. And they're sitting at about 6 billion. Now you imagine, as this business continues to grow exponentially as they take on the rest of the world, that 6 billion is going to translate into far, far more than that. And hence we have a share price, or a market cap of this company of 20 billion. That's 20 billion Aussie dollars. Small beer when you compare it with NASDAQ. And that's another very exciting thing. It's big stuff in Australia, on the Australian market. But when the Americans really discover Xero, well, who knows? And then look at those margins, 85% gross margin. Why? Because they've got 3,000 staff, 2.5 million subscribers. I very rarely have to talk to the people at Xero. It's all done on the cloud. it's a business for this age. So I love Xero. The share price itself, just to go back a little to that, it started taking off about a year ago. The reason for that was that it broke into free cash flow. Some of the skeptics, I suppose, waited a little while to see whether that was sustainable. Now you can see it is sustainable, and we're likely to see this share reacting to the sets of half-year results as they come through. Unlike in the United States, in Australia, they also, like us, just report every 6 months. So you're probably going to see little spikes like that. We've seen a spike which has taken the share price up above 150 Aussie dollars. It's now sitting in the 130s. So it's at a reasonable level. We do, within this portfolio, buy shares over 3 tranches. If you recall, the reason for that is to take the exchange rate, the South African Rand exchange rate, out of the picture. So we just then trying to average out the exchange rate and buy the shares. And I'm hoping that the shares stay around $130, which is where we bought there, $137, rather than where it was over $150 recently. I'm hoping that it stays there for 3 months. And that's kind of a hope that you can live with, because the next set of financial results will be for the year to end March, which means they'll only be published probably in May. So we've got January, February, March. We've got 3 months of accumulating the stocks over this period. Maybe because there's no news flow, Xero will actually come down a little bit over this period. Anyway, so those are the basic reasons why we've bought Xero and how we do it within this portfolio, excepting unless there's exceptional circumstances, or unless we're buying South African shares where there's no Rand play. Obviously, you're buying them in Rands. We always do this. We will buy the shares over a tranche, 3 tranches. Even at the bottom of the market, when we bought Sasol at 28 Rand and Discovery at 67 Rand, when we bought the US-based shares at the time, Spotify and Cloudflare, both of those we bought over a 3 month period. And I would recommend that to you. I know it's hard. You sit there and you think, oh, I'm itching to get some of these shares in my portfolio. Just try and discipline yourself, because a lot to do with share investment is disciplines. Okay, so that's the first one. And that's what the portfolio is looking like now. It broke through 11 million a couple of weeks ago, and it's now sitting at 11.3 million Rand, and that's from a starting point of 2.2 million Rand in 2014. As you can see very clearly on this table, Amazon has been our superstar, but also up there, Microsoft, who would have thought, has done phenomenally well. Apple has done far better than it's the number 2 in the portfolio. Microsoft's done extremely well. We've done very nicely out of Netflix and the South African stock Discovery. But one that, looking back, we would have loved to have bought more of is Cloudflare, up 240%, and that's just in, less than a year. Spotify also in less than a year, up 125%. But I'm especially pleased now about 2U, which had been one of the negative performers. It was in the red, and it's now in US dollars is up 12%. So it's starting to catch fire. The compound annual growth rate, there it is. We had a good month, as mentioned earlier, in Rand, up 7.5%, the portfolio 5% in US dollars, and the compound growth now is 30% over the last 6 years. Individual stock performances, there they are for you. You can imagine that when you've got one stock that's a 12-bagger now with the Amazon performance in Rands, it's very difficult not to have a good return on your portfolio, but the rest of them have also performed well, and 2U now finally broken into profit, even in Rand terms. And that's just the graphical sign of it. I wanted to just show you quickly 2 other issues that have happened in the past month. We've got, by the way, this week, a lot of our holdings are going to be reporting their quarterlies, and that's big news events in the United States. But Netflix came out last week, and I was particularly happy with what I saw in Netflix, and so should you be. The share price reacted very positively. It put on, I think it was 18% at one point, but the financials are really, really strong. And you can see this is from when we bought Netflix around 2 years ago, And the most recent spike that went up there was as a consequence of the financial results. Why? Well, that's part of the picture, that the quarterly revenues continues to grow. Interesting thing here about Netflix is that they did have a price increase, and some people were worrying that that would affect the Netflix growth proportion. The subscriber growth in the first quarter of 2020, remember that was going into the pandemic, particularly in the United States. The concern that people had that they'd have nothing to do when they were sitting at home gave Netflix a really, really good boost. So they pushed their subscriber growth in that quarter was phenomenal. Then as things started calming down, there were concerns that in third quarter 2020, Netflix might even be going X growth. We had a lot of other streaming players coming into the market. Reed Hastings said at the time, and the Netflix share price actually went down a little on those figures. The third quarter, only 2 million new subscribers in that quarter were added net. So they didn't go backwards, but they only added 2 million. He said, but we're not competing with other streaming services. We're competing with free-to-air television. And by comparison, the streaming services are around 10 to 12% of the total market. So they've got a huge elephant still to eat. And then came the fourth quarter results, which were again excellent numbers, the third highest quarter ever. Fourth highest quarter ever in growth, more than 8 million new subscribers added, most of those in our area, by the way, EMEA, Europe, Middle East, and Africa. Around 4 million of that came from this part, and this is a very, very rapidly growing area for Netflix. So when that came out, then there was great excitement from the investor base, and people then came into Netflix more aggressively. There you can see this was from their presentation of the letter that was sent to shareholders. You can see how well the company's done in 2020 relative to other years. And even though their forecast is very modest for 2021, it's alongside the lowest of the last 4 years, it would still be phenomenal. Again, remember compounding growth. But 2020 has been an amazing year for Netflix. And if you're a Netflix subscriber, I just thought I'd put this on there as well. They put this in their letter to shareholders to show that of the 10 most Googled TV shows, so what do you want to watch kind of thing, 9 of them are on Netflix. That's unbelievable. And they've only recently started going into movies, and you can see 2 of the top 10 are already Netflix as well. This is a company that is expanding. It's got a lot of runway to go. Well, we obviously delighted that we put it in the portfolio when we did a couple of years ago, but it's still got a long way to go, and it's had a fantastic January as a consequence of those financial results. Also, the second star performer in January was Naspers. Look at that surge in the Naspers share price. You might remember, those of you who've been coming to these webinars often, that 2 months ago I was saying, I don't know, with Donald Trump, attacking the Chinese stocks, would that affect Naspers? Naspers seemed to be a company that, the share price, as you can see there from middle of the year, seemed to be declining. But then we decided not to do anything about it, because when you consider the discount that Naspers was trading at just to 10-cent shares, it was like a 60% discount. Then it was a no-brainer. You had to have it in your portfolio. It would be really dumb to sell it. What's happened now is that discount is narrowing only slightly, but the Trump dump, as we call the Americans, by putting Trump out of office, all of the risk of American shareholders or American investors not being able to invest in Tencent, which is the company that Naspers owns 31% in, well, through it and Process, its subsidiary, that was eliminated. But the second thing was Naspers has been investing $5 billion between Naspers and Process in buying back shares. So we have a share buyback and the relief rally from the Trump dump. And here we go. Naspers is way into new record high territory. So very happy that we stuck with it. And the second thing there is to you, I've given this graph on the period that we've owned the stock, it did very well initially, and then they issued shares to fund the company. Very good for the company, because the company is now sitting with hundreds of millions of dollars, which it issued at around $40 odd a share to new shareholders. But other shareholders were quite unimpressed, and you can see the share price went right down into the early 30s for a period of time, and now since early December, it's starting to rise again. Those of you who've been following the story of 2U, it is the global leader in online tertiary education, so online university education, and it is a phenomenal company. It actually owns Get Smarter, a South African startup that the Paddock brothers created in Cape Town, and 2U is just one of those companies that is a huge beneficiary of the mega trends that are happening, and it seems like people are starting to wake up to this now. Small cap in relative speaking to others, but again a star. And when you see a share like this going up 18% ahead of financial results, you probably know that somebody somewhere said, we're going to be showing good numbers. Okay, so there's the portfolio as it's standing today, the Biznews Share portfolio, with only the one Wilson Bailey in the negative. And that's the presentation part, the first half of this. Stu, I see there are many questions, so we're going to have to try and get through those as many as we can.
No, thanks, Alec. Just two from Robert and George on Xero. Robert asked, are there barriers to entry for an alternative not too low? And then George says, is it not a takeover target, almost like Slack?
Yeah, both. First of all, there's no barriers to entry, excepting for the getting the accountants to actually switch over to a new software system when they're already on a very good one. I've played, given my proclivity for technology, or to use technology rather than having to use people to do tasks that can be done by tech. I've played with software, many types of software, and especially on the accounting side, because if you don't have a handle on the detail, you can't run a business. And in our business, it's quite a competitive market. You've got to really be on top of things and know your numbers pretty well. And there have been many pretenders, but nothing even comes vaguely close to Xero. So I guess, yes, there is always a potential that somebody else can develop a software accounting system that will knock Xero off its perch. But at the moment, it's had the benefit of being able to play in the Australian and New Zealand market, and now it's starting to go into the international market. And we in South Africa are we're a very good test case, because if something works here, we as a nation are a lot more, our first world part of this economy, are a lot better at understanding or testing new tech than most parts of the world. I think the second point is a very good one. What you can be guaranteed of, it's not going to be a Chinese company that acquires Xero if Xero is bought. But at some point in time, you've got to believe that a Google or an Apple or someone of that nature will be looking at this 20 billion Aussie dollar company, what's it, about 15 billion US dollar company, and saying, my goodness, if we can put this into every household in the United States or every small business in the United States, it would be so much bigger than it is today. Whether the Aussies and New Zealanders, well, the New Zealanders who started it, would be keen to let one of their national assets go, I suppose is a moot point. But yes, like Slack, the big fish will be swimming around.
You touched on Slack there, Alec. I think we sold it in the last webinar, but Gail and Shaman just want to know, what was the rationale for selling Slack?
Well, the rationale was that the price had been set, and you really were just earning interest on it. And the idea was there was really no upside, because Salesforce.com had made the offer. The price had adjusted according to the offer, and we saw it. The problem with takeovers is they can always go wrong. Something might have happened, and had there been a takeover, had something happened and the takeover not gone through, and the slack price then would have dropped 20-30%, which is what it went up. Remember, it went up very sharply on the offer. So the money's in the bank. It's what you're going to get anyway when Salesforce do conclude the transaction. So, and we didn't want to buy Salesforce at that point because it seemed pretty expensive. So rather sell the shares, bank the money, and let's look for something. And we found it in Xero.
Thanks, Alec. What's a webinar without Tesla question, Alec? Javant and Niels want to know your thoughts on Tesla.
Well, thank you for embarrassing me again. Tesla was the stock that keeps us very, very humble here at Biznews. Every time we have a look at the successes, it reminds me that Warren Buffett tells us to trumpet your disappointments or your failures and be quiet about your successes. We bought Tesla shares in the 200s, late 200s. We sold it in the early 300s when Elon Musk in 2018 was going nuts, it seemed. He was fighting with everybody, including the short sellers, the SEC in America, and I just wasn't sleeping well at night with Tesla in the portfolio. Of course, that was about the dumbest thing that ever happened. I should have just said, well, at least here's a South African boykie from Pretoria. Just stay with him out of royalty or whatever, because Tesla has been a phenomenal performer. Unfortunately, right now, it looks like it's overpriced, overcooked in the short term, and the greatest authority on that would be Musk himself. And Elon Musk actually went out and raised another $5 billion by placing shares a month or so ago at a significantly lower share price than it is at the moment. And there's no way he'd be selling shares at $600 if they were worth $800, which is what you're going to have to pay today. Just be patient. Don't get caught into the FOMO. It's overcooked. It's a great company and a great visionary who's leading it. But when retail investors get the bit between their teeth, they buy often shares without really knowing what the value is. And as far as the voting machine is concerned, remember Warren Buffett says that a value is what you get. The price is often a reflection of a voting machine. The votes are at the moment for Elon for president, and those votes are just pushing the share price of Tesla through the roof. You don't really want to be following a voting machine. You want to be buying value.
Thanks, Alec. Just two questions on Discovery. Fred wants you to please remind him why you included Discovery in the portfolio. And there's a follow-up question on, with the recent dip, is it a good time to sort of stock up on some more Discovery?
Discovery is maybe, I don't want to say the only world-class company to come out of South Africa, but it is one of very, very few. The operation it has in the UK, Vitality, is quite a phenomenal competitor with very large, well-established players in the healthcare field. It has a partnership in China with Ping An Health, which is probably worth more than the market cap of Discovery at the moment. Discovery owns, I think, 25% of Ping An Health, and that is just phenomenal, the way that that's growing. It grows like by Discovery South Africa every quarter. It's just the numbers are very difficult to get your head around. It's a great bunch of managers. They are visionary. They have a new business model which is different. Their business model being shared value. So if you become a Discovery client, you will get back by acting and behaving correctly what you save by them not having to pay you out for medical claims or death claims or car accident claims. I recently went onto Discovery Insure, the motor car insurance offering, and I literally get back 20% of what I spend on petrol every month as a consequence of that. It's because, and that is dependent on how I drive. And when I took out, you might have seen that in one of the newsletters, when I took out 2 of my tires by hitting a pothole in KwaZulu-Natal on R103 between Nottingham Road and Howick during the holidays. That's quite a challenge in itself. their service, Discovery Insures service, was just like off the charts. By the time I'd stopped the car, my phone was ringing, and it was their control center saying, "We see that there's been an impact. How can we help? Are you okay?" Now, it's just in a different league to everything else. So what they do at Discovery seems to be just so far-sighted, so far ahead of the game. And when we saw in March that the share price of Discovery had gone down to 67 Rand, it just jumped out at us, or jumped out at me, and I said, we've got to put it in the portfolio. Well, it was like having Sasol at 28, which we added there. So that's the reason. It was far too cheap at that price, and the underlying view of the business is extremely positive, particularly when you forget about the rest of the world, where they've got some wonderful partnerships as well. But when you just look at the UK and China, so it's a real world-class business run out of South Africa. At 127 bucks, you can buy it with your eyes closed. Yeah, for sure.
Thanks, Alec. Genevieve, just as while we're talking about pandemic and vaccine issues, she wants to know what your thoughts are on Aspen.
Aspen is one we missed. I did look at it in 110, 112 level, and in fact told a couple of my friends that I thought it was the stock to be buying there. I just didn't. It was one of those things that we only buy into this portfolio every month. So we missed out on that one, and at 140, well, it's probably still value. The reason I got so excited about Aspen was that we had Stephen Sard on one of our webinars, and you could not fail after listening to Stephen and what he'd done, how he'd restructured the business, and how it had taken a few years to get to where they were. And then you look at it in the 110 to 15 level and you think, come on, you know, this is a stock that was north of 300, and it's now a better position than it was before. And we have a pandemic, which surely if anybody's going to benefit, it's got to be the pharma companies, because we're all going to be wanting more pharma going into the future. And that's not just us as citizens, but governments as well. So it's one that we missed out on in this portfolio, I'm afraid to say. But I can't fault it at 140 Rand or the level that it's at the moment. If you've done your homework, I don't think you're going to be disappointed there.
Excellent, thanks, Alec. Grant just wants to get your thoughts on Microsoft and the share price right now, given it's nearly at an all-time high.
Grant, we invested in Microsoft for very, very specific reasons. And that was, as you can see, it was at $77 a share at the time. That was when Microsoft moved its model. It changed its model from selling products that you went into the store and you bought per annum. You kind of bought the product. You bought your Microsoft Office for a couple of $1,000, to becoming an automated, customer-driven business. It was something that has benefited us as well. When you look at Adobe, Adobe's the same thing. We're big fans of Adobe here at Biznews. We have Adobe Audition. We use InDesign. And a number of their other products as well, and we pay monthly. And that, for a company, when you have got cash flows coming in every month, it's why, although we only charge £4.99 or 100 Rand a month for our premium offering, it's a very, very solid base, because we know at any time that amount of money will be coming into Biznews every month. And if we look after our customers and we can grow it and we can keep the pricing correct, don't push up the pricing, then they will stay with you. You will maintain that, and it's a solid base before you begin. So you have annuity revenue in business, and I'm sure lots of you run your own businesses or know about your own businesses. If you've got annuity revenue coming in, it makes it so much easier. And that's what Microsoft did. They moved away from the big ticket items to annuity revenue, and it continues to flourish. As long as Microsoft will stick with that model, I think that you'll see that the share price will continue to rise steadily. And it's quite amazing, actually, to see Microsoft as one of the top performers in this portfolio, and having doubled in price given the scale of the business since August 2017.
Thanks, Alec. Rob has a comment and a question. He says, read an interesting article by Andrew Hallam about how the largest companies will not necessarily outperform general stock market in the next 10 years. He wonders, is the portfolio not over committed to Amazon and Apple?
Yeah, I guess if you were starting the portfolio today, you might look at it differently, and you might not put as much or 40% of the portfolio into those two stocks. I've got a different view, by the way, and I think in tech and in the exponential area, you do find that the gorillas have a disproportionate benefit. So it's a little bit like Apple. Why did we buy Apple at what is the equivalent now of $31 a share in the first place? It was because the market was fixating on the sales of iPhones, which are the biggest revenue generator for Apple. So iPhone sales would then determine what happened to the share price, which was missing the point that Steve Jobs made right from the beginning, which was that he kept Apple as an ecosystem. It's no accident that when you have Apple software, it only works on Apple, because from the beginning, Jobs had this vision that he would keep everything within the one ecosystem. Now, if you look at the size that Apple's ecosystem has become, it has to give you a disproportionate return as that ecosystem gets utilized more. Take us. We sit here, I'm talking to you now, looking at an Apple iPad, an Apple iMac. I've got in my pocket an iPhone. I have the new iPad, which I use for all my writing, etc. I've got into that ecosystem, a little bit like Xero. When you're in Xero and using that accounting system, you get to know it better. Why bother to go to another accounting system? Once you're in the Apple ecosystem, you kind of tend to stay. It's very, very difficult, particularly because their products are just so brilliant, to think of going anywhere else. So would you be selling Apple? Well, Warren Buffett only came to the Apple party a couple of years ago. And he did it because he said he was sitting at Gorat's restaurant, the steakhouse that many of the Berkshire pilgrims to Omaha will have gone to, because it's his favorite steakhouse. And he said he was sitting behind the till, and he just saw how many people were coming there and paying with Apple phones, or how many were using Apple phones and sitting. And he said, hang on, maybe he needs to relook this aversion for technology. So that's part of the thing. Amazon, again, Amazon is a phenomenon. It's a company. If you read Jeff Bezos's story, and he writes his own annual reports every year, it's a company that started off with a day one philosophy. Every day they begin, it's like day one. And as the momentum grows, they get stronger and stronger. So I'm very happy to have 40% of this portfolio invested in those two shares, even though you're going to find the stocks like Spotify, who've got maybe more accelerated growth opportunities. You have to have a banker in the portfolios, and for me, those two are just great bankers.
Thanks, Alec. Colin's got a question on genomics. I know Magnus and Lisa brought this up on Friday's webinar, but he wants to know, he says it seems to be a serious growth trend. What is your opinion on this sector, and are there any shares in your watch list?
Sorry, it's, as Warren Buffett often says, there are three piles of potential investments that you make. The first pile is the businesses that you won't invest in, and that's often quite big. The second pile is the investments that you will invest in, and those are often quite small, and you might just be waiting for the right price. And the third pile that reaches all the way to the ceiling is it's too tough to call, and that's an area that I know nothing about. So Lisa and Magnus have obviously plugged into it. They're the people to listen to, or do your own research. I'm sorry, I can't help you on that.
Excellent, thanks, Alec. Roshan just has some thoughts on WBHO. He says, would you consider selling it now and maybe repurchase it in the next 2 or 3 years?
Oh, no, I'm not clever enough to do that. I think Wilson Bailey is a very, very good business. I know the business well, the executives well. It's been around for a long time. If you're in the construction industry, if you're a civil engineer, there's only one place you really want to go and work, and that is at WBHO. They've been through, predictably, I suppose, a very difficult time at the moment. We probably, not probably, definitely, with hindsight, bought too early. But on the other hand, for a period, we looked pretty clever because if the Chinese deal in Australia had gone through, Wilson Bailey would be probably north of 130 today. It didn't go through. The question mark has to be, now that you don't have anyone who's going to be buying the Australian operation, is it still worth holding on to? Well, I look at the business. What they've done in Oz, they've got a phenomenal company there. Unfortunately, they made one bugger up, and that was when they quoted on what's called the Western Highway project in Melbourne, and they got their numbers wrong. It was not one of the Wilson Bailey stalwarts who was running the business. It was a guy who was running it, who has subsequently departed, who was inherited from one of the acquisitions. So are they likely to make another mistake like that? Probably not. Where they are doing phenomenally well is in the UK, where they bought a couple of businesses. Burn is one of them, and they're doing very, very good business there as well. So although South Africa's pretty soggy, as we know, it's got huge rebound potential, and they're doing fine in the UK and Australia. So it's one of those companies that you should be happy to own a slice of.
Thanks, Alec. Jamie just wants to know, what is your definition for an exponential stock?
20% plus annual growth. Very simple. And sure. You can look at it from the Biznews portfolio performance. If you can achieve 20% compound growth, then the numbers just become ridiculous. And I'll just take you to that. There we go. You can see there that in the US dollar performance of this portfolio since 2014 has been 24%. Okay, it started in December 2014 at $200,000. 24% has given you $700,000. And part of the problem with us as human beings is that we find it very difficult to get our heads around compound growth. Warren Buffett calls it the eighth wonder of the world. And once you compound something at 20% a year, this is 24, so it's a little bit higher, but you compound something at 20% a year in a company, then the value of that company rises exponentially. And to go from 200 to 700 in 6 years is exponential. That's my definition anyway.
Thanks, Alec. I know we mentioned Tesla, but Pritesh wants to know if you know anything about the Chinese Tesla. I think it's called NIO, N-I-O.
No, I do know a little bit about BYD because that is a company that Charlie Munger invested in. If you're looking around the electric cars, China, etc., it's listed in Hong Kong. It's one certainly to look at. It's a battery maker, and they're focusing most of their attention now on electric cars. So that would be one that certainly is worth looking at, but I don't know the Chinese equivalent.
Thanks, Alec. There's a question from Conrad. He wants to know, have you ever considered buying Shopify?
I've looked at it. Sure, I have. Again, it's not one that I know well enough to be able to comment on.
Thanks, Alec. There's an interesting one from Mohammed, which I think you partly have answered, but he says the portfolio looks tech heavy. Are there plans to diversify away from tech at some point? And if so, what sectors would you have on your radar?
Mohammed, no, this is an exponential portfolio. I'll tell you where it all comes from. Quite interesting. First of all, my own background. I've been in digital media now for, since, 1997. So work that out. That's more than nearly 25 years. So I've had the front row seat in digital media, in the digital world. Clearly, that's something that I would know better than mining, for instance. But that's the first thing. You should stick to what you know. The second point about this was that when the guys came out here from the university, Singularity University in the United States, Peter Diamandis and co. And if you want to understand a little bit better, I would go and look at Singularity University. Peter Diamandis has a phenomenal newsletter that is well worth subscribing to. But anyway, they were brought out here by Steve van Coller, who was then the CEO of Absa Capital. He's now running EOH. And Steve said that he needed to change his own mind as well as the minds of his clients and of the people who worked within Absa. And would we, as a very young Biznews, I think we were around for about a year at that stage, like to be the media partner with this. So we went along to it. Justin, my nephew, who was our first webmaster, and we spent quite the whole week pretty much talking to the guys from Singularity, interviewing them, making videos, doing podcasts, and that's all on Biznews. You can find it all there. And the penny kind of dropped for me that the world is transforming from a industrial age into what McAfee and Brynjolfsson call the second industrial age, and the World Economic Forum picked it up and called it the fourth industrial revolution. So call it what you like, but it is a seismic shift. And in that transformation, you're going to have companies like newspaper companies that are going to implode, and we've seen that happening. And you're going to have other companies like new age retailers that are going to boom. So it becomes a once in a few decades or many decades transformation. Like if you were to go back at the change to electricity, the companies that were in gas and coal would clearly not have been the places to put your money relative to electricity. And that's why we've focused our attention in this portfolio on businesses that will grow exponentially because they're properly positioned. They're big risks here, and there are lots of people trying to get into that. But you've got to be in the right industry. It helps if you're the market leader, and you have to be properly capitalized. And fortunately, with cheap money, most of the market leaders, and certainly all of those who are in our portfolio, are well capitalized. So that's the story behind this portfolio. I'm not going to go out and buy gold shares. There's the only time that we deviated from that was twice. Once was buying into Sasol because it was just ridiculously cheap at 28 Rand. And the second time was Wilson Bailey, which was buying into the South African growth story, which I think everybody hopes and believes in, but has been somewhat derailed recently.
Thanks, Alec. We almost come to the end today. Robert just wants to know, you said you suggested Tongaat has great value to offer a while ago. He just wants to know what your thoughts are behind it, what would fuel its share price, etc.
I really like the management team. I don't understand the business well enough, and I've really tried. I've gone through, had a look at the balance sheets, at the income statements, the annual reports. I've read what Dave Willem has written about it, what Chris Logan has said about it. I just don't understand where, once they've done the turnaround, and there's big potential in that turnaround, I don't understand where they're going to get their growth from thereafter. So at the moment, it's turnaround, and if you were the kind of person who would invest in a stock for a turnaround opportunity, then I don't think you'll go wrong with Tongaat, because you've got really top class management there. Now, the problem that I face with Tongaat is that in this portfolio, every single share we buy as though we're never going to sell it again. And with Tongaat being focused on sugar and on property, although it might get to 20, 30, 40 Rand a share, there will come a time that it will seem to be overvalued. And where is the growth going to be in sugar? And where's the growth going to be in property if you're just selling off your property? So it doesn't qualify in the portfolio on the basis of exponentiality or long-term growth. It would qualify if you were a graveyard portfolio or investing in those stocks that give you a good turnaround. I can't see why you'd hold Tongaat for 50 years.
Thanks, Alec. And to end off with, Evan says, if you're considering further tech stocks and understand all products within the space, you should look at DocuSign.
Thank you. Thank you for that, DocuSign. There's another one, VeriSign, which bought Mark Shuttleworth, overpaid for him. If you recall, he had a little thing called Thought in the when that all started in the year 2000. There are many opportunities, and I would urge you to do your homework. Go and find the one in your sector, a company you understand. We've had the greatest success in this portfolio with businesses that we understand the products, hence Xero added to the portfolio today. If I start going into DocuSign, then it would only be after I've used their product extensively many times and said, this is by far the best in the market. We've tried everything else. These are the guys to go with. It's like Spotify. Why did we go with Spotify? Because they moved into podcasting, and we're very big in podcasting. That's our focus area for the future. Those are the kind of rationales for making the decisions that you do in investing. If it's something that you don't understand and it's something that somebody's told you, has recommended to you, but you like a Tongaat, you don't really know where the money's going to come from or where the profits are going to come from long term, then no one's forcing us to buy any shares. There's a huge, tens of thousands of stocks available around the world, and DocuSign could be one of those that grows exponentially. It's just not one I know as well enough yet, but who knows? Maybe it's worth looking at.
Thanks, Alec. I think we've come to the end now. It's 1 o'clock. Just on DocuSign, I was telling Clive I actually used it yesterday, but I see.
Well, there we go.
I don't know much else about it other than that. But
if it worked well, then and if it's better than Adobe's alternatives, well, why not? I tell you what I do like. I love the little independent companies that are doing one product kind of where they specialize in one product. Slack was one of those. Cloudflare is one of those. Xero is one of those. They do seem to just have more focus. You remember with Slack, when Microsoft came out with Teams, Slack share price went down because there was a thought that Slack was going to go out of business because Microsoft was going to wipe them out. Well, more and more I've realized in this industry, although the gorillas do tend to make the most profit, the growth often comes from the highly focused little guys. And we've seen that. Spotify have taken on Apple in podcasts. Apple owned podcasts, and Spotify has managed to build out a market dominant position there, overtaking Apple. It can happen when you're really focused. But it has been a real pleasure again to be with you this week, and I hope that you found lots of value here. We will have the webinar on the Biznews TV channel. Go and have a look there. If you've never been to our Spotify channel either. Compiled and produced by the team at biznews.com. Sorry, that was me talking a little bit there on our on our outro for the webinar today. But thank you very much for being with us. We have, if you recall, Stu, I think we've got a webinar on Thursday with Tim. Is he back on Thursday?
Hi, yes, thanks, Alec. Yeah, Tim's first webinar this year is back on Thursday, and obviously on Friday with Jackie, it'll be a second one. But we'll put the details of Tim's webinar in tomorrow morning's newsletter.
Yeah, and as a premium subscriber, if you're not getting your Rational Perspective newsletter, please drop me a line, because sometimes what happens is that it gets caught up in the spam box, or it has we've got the wrong email address for you. So if you're not getting the Rational Perspective newsletter as a premium subscriber, it's very popular, and I would love you to be able to see it every day. I do spend a lot of time putting it together. So just drop me a line to alec@biznews.com. And from us here at Biznews, thanks for being with us. Until the next time, cheerio. Thank you for joining us for this webinar, which is compiled and produced by the team at biznews.com. a recording of this webinar